these are important banks. These banks fail, and then you have an implosion on your hands.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, this community keeps growing more and more every single week, thanks to you, our Live from the Vault community. Now, there's a lot to talk about during these historic times, and fear not, because we have the one and only Andrew Maguire in the house, and we'll be talking gold. This is going to be an amazing episode, so fasten your seatbelts. You know, Live from the Vault gives you access to information and updates that you just can't get anywhere else, and this episode is no exception. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, Andrew, on our first episode of 2023 back in January, you drew attention to a massive escalation of the long-standing paper-to-physical battle and why we're going to see such much higher prices, physically driven prices in this quarter. Now, that did happen, as a matter of fact. And then last episode, just 2 weeks ago, you drew our attention to some fresh new bullish drivers for this quarter. Can you update us and update our subscribers on these bullish drivers?
Yeah, Shane, it's great to be with everyone, yourself, and this whole community. Look, as we know, our focus is really on how this rapidly unfolding geopolitical event, this is unprecedented, how this is going to translate into a gold and a silver price reset. So with that in mind, let's add to what we observed in our last episode, where we looked at the real reason for President Xi's visit with Putin in Moscow and how this pivotal meeting cemented both a military and a financial alliance, which is really going to significantly accelerate the de-dollarisation process. And given that gold is inversely but bullishly correlated to the dollar, how this is going to impact the all-important physical gold market, which is really what we focus on. And as we previously discussed, opting out of the hegemonic dollar-based system requires opting in to a sufficiently liquid alternative medium of exchange. Now, physical gold, once again, once it's actually delivered into the hands of the receiver, it's the only global currency that has zero counterparty risk, and it is infinitely fungible, which is another very important point we talked about with Dr. Stephen Lee last time. It has to be fungible sufficiently to provide a liquid solution to be able to opt out of the dollar and into a gold-backed solution. However, as physical gold, and you can read silver into this too, Shane, I know you want to, as they get readopted in an eminently fungible global settlement currency, it'll shake off its paper wrappers and be revalued at a much higher price that is presently baked into gold's dollar-denominated supply-demand price, which is what we're seeing here. And we're seeing a bit of a ramp today, but this is nothing to what we're going to see. And as we drew attention to the ability of the Sino-Russian alliance to access a potential aggregated 60,000 tons of physical gold reserves, it provides this unfactored, unpriced opt-in solution. And if anyone missed that episode 2 weeks ago, where we kind of dug into how that 60,000 tons may actually be available. And let's first deal with the military side of this, as it is actually the driver that is accelerating the process. So not to forget, our focus here is on the impact these escalations will have on gold, and to also draw attention to just how underpriced physical gold and related silver is as this process rapidly unfolds. We're watching history in the making here, guys. People will look back at this. This is unprecedented. And directly following Xi's meeting with Putin, which, if you recall, was concluding just as we recorded the last episode. It was that on that Wednesday. They were just winding it up then. But since then, Secretary of Defense Lloyd Austin and Chairman of the Joint Chiefs of Staff, that was Mark Milley, he told Congress at the Pentagon's 2024 budget request, which was really almost concurrent with that, he said it would help the country to prepare for a future war with China. Those are his words. And Milley said that China's actions are moving it down the path towards confrontation and potential conflict with its neighbors and possibly the United States. Those, again, are his words. Clearly referring to Taiwan here. And increasingly, these increasingly dangerous confrontations in the South China Seas. Now, his comments really echo similar warnings made by Chinese officials. Now, this rhetoric is really ramping up. You can't ignore this stuff. Chinese Foreign Minister Qin Zhang immediately countered these statements, stating that if the US doesn't change its course on the military buildup in the Asia Pacific and the other policies aimed at China, it will lead to, his words, conflict and confrontation. I mean, look, come on. You know, how many times do we want to hear this? This saber rattling is morphing into action points between two nuclear powers. You know, we get sort of so sidetracked. You know, it's just more words. This is not words. But this is the most important thing that we assessed last time. Yeah, this is dangerous. But because each of these, there's three basically globally interconnected nuclear superpowers here, the US, Russia, China. And each of them have got the ability to eradicate each other and us overnight. So ultimately, restraint will have to be exercised because it's going to blow back on them too. So this means that the nuclear option will be played out in the financial markets. And the stronger hand lays with actually the 2/3 of the globe that are divesting dollars as fast as they can to hedge against this growing risk and to ultimately fully divest unipolar US military and financial hegemony. Now, hegemony is obviously, it's not just financial. And while Russia, like red lines, are now being pushed in China's direction, China's readying itself for an inevitable deep state pushback and is actively seeking to insulate itself from the only tool, well, one of the few tools left in the deep state's hegemonic war measures toolbox, which is sanctions. So possibly freezing, maybe seizing Chinese assets. And with the Russia dollar weaponization lessons learned very recently, China is setting up dollar hedges.
All right. Now, Andrew, you just talked about certain measures that China was taking to insulate itself from Russia, like the sanctions being imposed on it. And I know you have some very good lines of communication open worldwide and even on this side of the globe. Can you tell us what you're seeing?
Yeah, Shane, the pieces of the jigsaw are really rapidly being assembled, and the timings are just not coincidental. Now, we have the Belt and Road Initiative now opens up the Central Asian Corridor. Now, that provides sanction-proof overland connectivity between Iran, Turkey, and China, allowing Russian and the anticipated upcoming China sanctions to be largely sidestepped. Now, the linking of these multipolar powers streamlines this process and allows China and Russia to play a very much stronger hand. So with the multipolar land bridge now opened and aware that the actionable red lines are being approached, China is looking to step up de-dollarizing as quickly as possible. But to do so requires an alternative currency, which is what we're talking about. Hence, the first port of call for Xi was to, after he was re-elected, was to ramp up this process with Russia with a view to rapidly accelerate the implementation of an already designed multipolar-backed gold commodities-based currency, bypassing the US dollar, but liquid enough to service the EAEU, the Shanghai Cooperation Organization, the BRICS Plus alliances, for them to adopt the same gold-backed currency design. Now, obviously, it has to be one design to fit all. So this is the most interesting part of it.
Now, Andrew, we've been saying for years now that these are historic times, but the speed that this is all unfolding is quite amazing. How long do you expect this process to take?
Yeah, Shane, look, I mean, kind of looking at the velocity of this, this move out of the dollar following the Xi Putin meetings, originally the BRICS Plus move to de-dollarize was projected. I mean, people were talking about it saying, oh, don't worry, it's going to take 5 years, 7 years to gain sufficient traction to really significantly impact the dollar trade. But following the Russia tokenizing physical gold on the peer-to-peer Stellar blockchain at the open of New Year trading, you remember we talked about this was mind-blowing. And following Xi's re-election and his fresh mandate to prepare his citizens for war, and we talked about that in our last episode, those are his statements. And so really out of necessity, these war measures see this timeline severely contracting. Now, our extremely well-connected liquidity providers from this side and that side confirm that the Sino-Russia alliance have sufficient aggregated physical gold reserves to ultimately tokenize the multi-billion-dollar energy and commodity sector, and assisted by a resulting significantly much higher physically settled supply and demand gold price. Now, it's estimated that the timeline to de-dollarize and will significantly contract to a pivotal inflection point. Look, guys, in a matter of months, not years. And I know that sounds mind-blowing, but we've got some statements here to read out, which are in a little while, but which just really tell you that this is actually getting really serious. Now, with this in mind, late last week, unable to continue ignoring the elephant in the room, we evidenced several mainstream media reports waking up to the implications of a faster than estimated move out of the dollar into alternative multipolar commodity trade settling solutions. And now, while most of the mainstream media reports, it was probably best summed up in a Financial Times article, because pretty much summed up what everyone else was saying. They're really trying to play down Putin's pledge to adopt the yuan renminbi for what Putin calls payments between Russia, Asia, Africa, and Latin America in a bid to displace the dollar. And they quote this in their articles. However, what's not factored into similarly constructed Bloomberg, Reuters reports is that the scope of this currency adoption is on a scale not yet realized by the mainstream analysts, who really try to psy-up and toe the line of the immediacy of this de-dollarization process. So, it's a bit like saying the banking system's broken. Well, they're not going to say it, are they? None of the analysts report, none of these reports factor in the fact that the renminbi, to be liquid enough to absorb an even larger percentage of global commodity and energy settlement flows, that the underlying yuan underpinning the offshore renminbi is going to be largely backed by physical gold. Not one of these reports even goes there, nor do they factor in that commodities increasingly priced upon a significantly higher dollar-denominated gold price will have massive inflationary implications for commodities priced and bought denominated in fast depreciating Western fiat currencies, dollar, pound, euro, you name it. Now, when considering this gold-backed currency will ultimately have to provide adequate liquidity to accommodate the lion's share of the 7,500 billion per annum global oil and gas markets, as well as, in addition, the 5,000 billion per annum commodity and energy sectors, then the scale of this potential gold adoption becomes absolutely clear. And that the gold benchmarked in dollars, that any gold right now benchmarked in dollars, will have to revalue at multiples of today's paper diluted dollar capped price. So looking at this scale of adoption, we looked at the potential, but the entirely realistic 60,000 ton pool of physical gold available to ultimately back such a gold-backed commodity currency. This is being ignored completely by any of the mainstream. While the massive bearish dollar pivot will not be escaping the attention of the extremely wrong-footed deep state hegemony ringmasters seeking to protect US dollar hegemony, the option of countering this attack on the dollar's reserve status by risking triggering an unthinkable nuclear war would just, again, that would blow back against them. So snookered, and they are, this likely leaves deep state very few options. So, this is a lot of stuff we talk about with the liquidity providers and well-connected people. Doubling down on the current in-play attempts to break the back of us 1.8 billion NATO members, these economies, well, they're trying to double down and break them faster, so that obviously you have to break it so they can continue to try and fulfill their World Economic Forum mandate to build back better. You hear them, Biden talking about it, hear everyone talking about it. This is something they cannot do once dollar hegemony is undermined. So they're scrambling. This is what we're seeing. We're seeing these strange laws and sort of moves, woke sort of moves coming in, and they defy logic. So there's a reason for this, because in order to build back better, you've got to break something. Now, the ill thought through Russia sanctions have already severely blown back on the deep state's objectives. So by weaponizing the dollar, it inadvertently forced the acceleration of the de-dollarisation process, and in turn eroding the bandwidth to be able to complete these WEF unipolar objectives, risking blowing this plan's timeline out of the water. Now, the narrow old guard thinking completely discounts the velocity of 3.8 billion SCO members, and not to forget, that is also a military alliance bolstered by 1.5 billion African state members. None of these people are interested in or have the luxury of indulging in pampered, woke ideologies. Look, everyone's too busy working. They find it far better to cooperate with each other, even if they were traditionally enemies. Far better to cooperate in order to build themselves better lives within a far more equitable, multipolar world. All of which is increasingly leaving the US in the rearview mirror. Sanctioning China is only going to accelerate this process. So into this process, the Sino-Russia Trojan Horse is actually hidden in full sight. And over the last few weeks, we've evidenced an increasing adoption of the alternative PBOC-backed cross-border payment system, which is the CIPS system. Not much talked about. China launched the CIPS, goodness me, it was back in 2015, and it was really to internationalize yuan use. This is long-term thinking. And it readied itself for moments like this. It allows global banks to clear cross-border yuan transactions directly onshore instead of through the clearing banks in offshore yuan hubs. So, and interestingly, CPIS also counts several foreign banks in there. Shareholders, HSBC, Standard Chartered, Bank of East Asia, DBS Bank, Citi, Australia, New Zealand banking groups, BNP Paribas, they're all part of this, a party to these transactions. So this is interesting stuff. So the Russian equivalent, which is the SPFS, that's the alternative, the Russian alternative to SWIFT, also connects to the CIPS. Start to think about these connections. And up until very recently, CPIS has flown under the radar, and it's because it's largely connected domestic Chinese payment systems with one another. But by no coincidence, following Xi's meeting with Putin, we now see an increasing adoption of the payment messaging system by BRICS plus countries. And if we just name a few notables, and in fact, I just have to read this, because this is from Kenyan President Ruto, urging his people to dump dollars as his nation refuses to buy energy in dollars going forward. And he says, quote, "For the people who work numbers, I'm giving you free advice. Those of you who are holding dollars, you certainly might go into losses. And you better do what you're going to do, because this market is going to be different in a couple of weeks. Now, come on, this is if Kenyan president is doing this, well, this is serious stuff here. And yes, people might poo-poo a couple of weeks. No. I mean, if you start dumping, if you wholesale start dumping the ability, and the Congolese governments are talking about it. I mean, this is unprecedented stuff. So also Moscow is increasingly using the renminbi for its ballooning trade with Russia. It's amalgamating a gold-backed yuan into its own backed central bank, gold-backed central bank reserves. And as Putin puts it, to reduce exposure to the toxic American assets. This is a perfect storm. Last Wednesday, we also had Banco Bocom, that became the first Latin American bank to sign up as a direct participant to CIPS. China is Brazil's biggest trading partner. They've got about $200 billion in bilateral trade last year, and that's going to exponentially now move higher. And in doing so, China is extending its bilateral US dollar exempting currency arrangements beyond countries such as Russia, Pakistan, Saudi Arabia. They're now including the Latin America exporting powerhouses. This is serious stuff. Saudi Arabia is now joining the anti-Western influence bloc formed by Russia and China, cementing Ryder's deepening ties with Beijing as the US pivots away from the Middle East. The kingdom's cabinet approved a plan to join the Shanghai Cooperation Organization as this, for the moment, a dialogue partner. But that's just a precursor to being granted full membership. Don't forget, the SCO also provides a military solution that obviously one of the arrangements was, the original arrangement in 1971 was, hey, America will come and supply, we'll come and protect you, we'll provide weapons, but you just got to use the dollar to trade oil. Hang on a minute. Something's changed here. You've now got other military powers, when combined, are actually more powerful than any around in the West. And this was followed by, again, another one, Saudi Aramco agreeing to buy a stake in one of the petrochemicals out of China's refining giants. That's, again, expanding its presence in the world's biggest importer. China's national offshore oil corporation and France's Energy have agreed to one settling LPG trades. And so the development, I mean, look, these developments follow an earlier warning from former Fed and US Treasury Department official Posar that we would be witnessing the dusk of the petrodollar and the dawn of the petro yuan. You remember this, it was well advertised. And he was referencing the BRICS nations' migrations out of the dollar trade. This is now escalated. And this is just the tip of the iceberg of a fresh avalanche of sanctioned de-dollarizing moves that directly follow the pivotal meetings between Xi and Putin. The very meetings that are being played down. And this couldn't come at a worse time for the US dollar's deep state ringmasters. And these moves are currently confluencing with the next level of dollar debasement following the last 2 weeks of US banking turmoil. And as we know yesterday, which is Monday, we're recording this on Tuesday to make sure it's ready for the holiday weekend. So yesterday, the markets surprised us all, us too. The markets were blindsided by a surprise OPEC plus oil cut. Nobody was expecting this. It was just another shot against, right across the US dollar hegemonic bow, sending a clear message to the US that it's no longer a unipolar world. And the resulting inflationary implications caught a sleepy holiday shortened market off guard, severely ruining all the crosses. In other words, all the bonds, the dollar, really the chaos that caused. And then the inflationary concerns starting to roll back into the Fed. Look, if you add into the mix that the Fed, the extremely wrong-footed Fed, battling inflation but hobbled by the pace that their recent hikes triggered this recent banking crisis in the first place, and having burned complete credibility already, the wrong-footed Fed is now caught between a rock and a hard place, forced to either tail off rate hikes or, when the next commercial real estate shoe drops, and that is the next shoe to drop, or almost certainly, it's forced to start cutting rates then to avert triggering a far worse bank run. This time driven by interest rate differentials between regional banks, which is the core banks that America grows up, supplies to all the root cause, to all the primary regional people. This is the regional banks supply money to most of America. Forget the big, too big to fail banks. These are important banks. These banks fail, and then you have an implosion on your hands. And obviously, higher rates, so you've got a differential between the regional banks and higher rate ballooning money market funds. So what is that going to do? It's going to force more money out. So what's the Fed going to do here? I mean, this is a serious issue. So bottom line, though, we think about gold. This is a perfect storm. Undoubtedly the most bullish setup for gold since Nixon removed the dollar convertibility peg over 50 years ago, and foreshadows the end of the Comex as a paper market suppression tool. Paper market pricing divergences, it's going to force the EFP delivery, in other words, the exchange for physical connection between the futures market, which is non-deliverable, into the deliverable, NSFR compliant, deliverable T+2 spot market, the delivery market. And given the unfactored ramped up pace of this de-dollarisation, it'll undoubtedly force a gold price reset within months, guys.
All right. Now, Andrew, that's a lot of information. And thank you so much for kind of untangling all this chaos here. But as you know, we've got a very, very large following here at Live from the Vault. And, it keeps growing. I keep on saying it keeps growing and growing and more every single week. But we're also followed by a lot of professional traders who are interested in what you're seeing in the shorter term from a physical market perspective. Can you share with us on the physical market perspective?
Sure, and that's true, because there's a lot of, look, every professional out there has their own charting software, technicals that they follow. But the important thing to know is, where's the physical support? Where is the central bank support? Where are these aggregations? Because you can have a technical chart that will not be breached or will get breached because there is a lack of, or because there is support there, it will hold. So look, I'll just share what we and our well-connected liquidity providers are seeing. But with that in mind, and in lockstep with every first-tier bank on top of really no one, never to be sold physical holdings. No one is selling any physical gold holdings. You've got to be aware of that. No first-tier bank is. So what are we doing? We're doing what all the other guys are doing. We're holding all our positions, long-term, long and strong, while very short-term. Well, yeah, there's expected to be some opportunities to add gold and silver into. There's bound to be attempts to contain last week's 2,000 spot gold level. Well, you're just getting it breached now here. So great. If they can't contain that, we're going to get a higher stair step. So this is, so in gold, that's 2,000. In silver, they were trying to cap 2,400, just getting through now, breaking through again. They've been, really, it's about, we've had China on holiday until Wednesday night. So we've also had illiquid conditions. So you've got the usual gaming going on. So, but once 24 breaches and holds, then these derivative resistance levels, which are just paper positions, opens up very large short stops. In other words, these are the bets where you need to unwind these bets against those prices being breached. And they're just above these levels. So we've got a really explosive situation here on our hands. So very short term for gold. And as we assessed last time, we've got this T+2 spot demand being crystallized at every single Basel III compliant PM fix. And it's forcing market making bullion banks and the liquidity providers to hedge this constantly rolling physical delivery exposure. It relentlessly comes in. So whatever price they want to play the paper game, there is the right to take delivery. That's what's happening. And this will serve to cement a significantly higher stair step into what is always an obligatory non-farm payrolls gaming on Friday. Well, maybe they capitulate and don't do it this time, but in all of history, they've always played a paper game into non-farm payrolls. In fact, many central banks and sovereigns sit back and large buyers will just wait back and let it play out because we'll be there. But maybe not. Maybe the first-year banks are really concerned this time because they're exposed to, this is the first year they've been exposed to Basel III delivery requirements. So drilling down under the smoke and mirrors market action, we continue to evidence the bullish paper market footprints. And this will mean something for the options traders that follow us. And I'm sorry, everyone else, I'll keep it brief. Options, I know we don't want to talk about it, but when we saw the April gold contract, this is important for I'm sure a lot of the professional traders would know this, but it's interesting. But when we saw this contract, the April gold contract, which just expired and is now in delivery, move into delivery a few days ago, despite a significantly call put options imbalance, where, in other words, we had 120 tons of expiring paper gold contracts converted into a delivery contract versus just 8 tons choosing to deliver this non-delivery paper structure. It raised a red flag, especially as JP Morgan, the agent bank, alone, this is an agent bank who alone controls just themselves well over 50% of the Western metals markets, paper, gold, and silver derivative positions. So historically, what do we expect? Because this is not real bullion, it would ordinarily have indicated downside, deliberately disruptive air pockets. In other words, you're a market maker, you can pull your bids and you can create an air pocket. And you know where the stops are for the speculators. You know that they're long and they have a margin position and they borrowed this position and you can usually take them out. But and we saw that in both gold and silver. But in this case, when weighed up against the extremely tight, strong demand delivery market, which the same insiders are exposed to, we really kind of anticipated this time that any bid pulling rollover gaming would be limited to the very few non-sticky speculators. In other words, the rinsable speculators, not the sticky ones that are not moving anywhere. And that means it would be relatively shallow. It was. And it's a really good sign that the paper market is struggling to contain a very much more physically driven market. So this change in behavior looks to be playing out into a very strong physical demand market. But we do expect some participants to be sitting on the sidelines into this holiday shortened week. So, want to know short term, non-farm payroll comes in on a US market holiday. There's going to be no PM or silver fixes, no gold or silver fixes from Thursday onwards. So you've got Friday's a holiday, Monday's a holiday in the UK too. So you're going to have no fixes. So it's going to be illiquid. So could this offer an opportunity to add some more and take some more off the cartel? And if you are a stacker, who cares? It's cheap already compared to the real price of gold and silver, which nobody knows that price. So whoever you are, you don't know that price. Sticky specs, that is the ones that you cannot rinse, with a longer term view, had already rolled their April contracts. They weren't going to take delivery, but they just want to ride the price. Or it's a hedged position to a risk position. These contracts are locked in. They rolled into the June contract, which now everyone has rolled into, well before delivery, and what they're doing is looking for much higher prices, while the remaining delivery open interest, in other words, what has yet to be delivered, is largely in the hands of the market making insiders exposed to this T+2 NSFR compliant spot delivery overhang. So we will continue to expect 1950 to provide very strong support. And it already did this week into Monday when we saw this crosses being roiled. And while we always expect volatility around the round numbers, 24, 25, 26, in silver, 2000 in gold, whatever, we see the option sweet spot aggregating higher to 2050 now. Now that is like much higher than it was. It's about $100 higher than it was just last month. Now as this settles in, the next central bank supported stair step comes in. And then if it is, watch out above.
Wow, this has been a big episode with a lot of chaos that you're untangling here, Andrew, but I just can't let you go before you take a deeper look at what's happening at my favorite topic, which is, of course, silver. And to all the silver stackers out there, you want to listen to this very carefully. Over to you, Andy.
Yeah, we love silver, don't we? Yes, Shane, I know you do. I mean, and there's never a day that goes by where we don't talk about silver. But yeah, notably, really, silver has been acting relatively better than the current in-delivery gold contract, futures contract. And what that reflects is an extreme, and I mean extreme in capitals, silver wholesale market tightness, and that confluences with very depleted Comex open interest. So in other words, the what is registered and able to be delivered in the Comex is far too little to be delivered. All of this is really constraining insiders' sell efforts as they're forced to adjust their bearish derivative bets higher, because you don't want to open up the back door for somebody to come in and take it off you. So silver is expected to continue to outperform gold into what is really an insider move to unwind the ratio trade. And if you remember what the ratio trade is, simply where you're basically, we've seen the amount of ounces of silver it's taken to buy an ounce of gold should be 11, 12, maybe 16 to 1. It's been up to 120 to 1. It's been recently in the 90s, beginning to get unwound. We knew that we said this has to get unwound, because if you want silver, then that's the next trade you go in and start to attack. And while this unwind of silver shorts, which is really what it is, you're shorting silver to buy gold. Now we're seeing the inverse. So obviously when you're buying back these shorts, you're selling gold. This is kind of assisted. This is the reason why it's outperformed gold very, very short term. But all the time there's buyers coming into gold. But this is a good sign that insiders are busy clearing these very stale bearish paper bets in silver into a very strong Asian physical market. So as we assessed last time, there was really no reason for insiders to see silver below 24 at the end of last month, and it did hold above that level. Then we saw some gaming and the usual paper market gaming ahead of non-farm payrolls. Hey, but look like it's blasting through again. I'm not counting out, but really the option structure, really, once we see this 24 breached, it's really looking more like 26 right now, which should be more comfortable. Remember, we said 24 would hold because the insiders were basically, they didn't need it below 24. Now we're looking that they probably don't need it below 26. Now, as far as silver is concerned, though, a hold of 24 opens up 26, which is the last line of defense before what we call a gap close all the way into 2012. And that sell trigger, you can look at any chart, you go to 2012, and you can see that's where the sell trigger happened. Gaps get closed. $35 is where that gap will get closed. So really, the trigger point, the exact trigger point, 26,225. Get above that, hold that for a pit close, 35. It has to be. So to sum up what we see and expect, this is the strongest central bank related support for gold has now aggregated at 1,930. And if you remember, that's a full $110 higher than what we evidenced on the 7th of March. Now, insiders, if you remember, we looked at this closely, they ran into central bank bidders. If you remember, we identified them, it was 1820. Now, while we do see some specs still left to rinse, we think 1930 will be significantly front run, and footprints suggest any paper gold moves down into 1950 is sufficient to really kind of run out the non-sticky specs anyway. So very, very short term. Most paper market participants will be on the sidelines ahead of holiday market non-farm payrolls, or maybe they're running for the hills, but usually they're on the sidelines. So you may see a little bit of illiquid volatility, but with both gold and silver in such strong physical demand, the cartel will be very wary about wholesalers circling back to the back of the Comex door for supply. So that leaves us only one question, guys. How much physical do you own?
All right. And with that, thank you, Andrew Maguire, for talking gold. And remember to our entire Life from the Vault community to buy physical and make sure it's one-to-one. Make sure it's physical and understand the difference between what Andy affectionately calls the casino paper, gold, and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode and power-packed episode of Live from the Vault. Now, please help us and keep spreading the word about this channel by hitting that like button right now and by sharing it and also by subscribing. If you click on that bell that you see, you'll be notified in real time as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.